accounting depreciation is not allowed. What is allowed is the tax depreciation. Now, this tax depreciation is what we refer to as the capital allowances. So we can say that capital allowances is the standardized depreciation that is allowed for tax. So when you come to capital allowances, we mean the standardized depreciation which is allowed for tax, and it is categorized into two. That is the accelerated depreciation this one is sometimes we call investment allowance. And the number two is the normal depreciation, which is the wear and tear, or what we call the wear and tear. Now, there is still a small issue regarding the accelerated how to take the capital allowances, but I'm expecting to get a confirmation from probably Equipara by Monday. That's what they promised me, but we are going to use the available knowledge that we expect on this part. It may change or it may remain the same on capital allowances. If it changes based on what the other information we are going to get, then I will update you on that aspect of capital allowances. Now, let's look at the first one, which is accelerated depreciation. This one, sometimes we call it investment allowances as per the previous law. Accelerated depreciation, or sometimes we call it investment allowance. And this accelerated depreciation, it is given to a registered investor. The important aspect there is that the investor must be registered and must invest in a new or used asset of 50,000 USD each. Each asset should be having a value of 50,000 USD. In that case, the allowance can be given. We can say that an accelerated of 50% is given to a registered investor who invest in a new or used asset of 50,000 USD each. That word is very important when we are looking at it. There are mainly few words there that are very important. The first one, which is very, very important, is this one: a registered investor. For someone to get an investment allowance or an accelerated depreciation, that investor must be registered with RDB and they must be having an investment license recognizing him as a registered investor. Another condition is that each asset should be at least 50,000 US dollar. Those two information are very important when you are computing capital allowances. Other conditions for accelerated depreciation number one, because these are the two important conditions: must be a registered investor and must invest in a new or used asset of $50,000 each. Other condition must, for the investor, the investor must invest in priority sectors. The investor must invest in priority sectors, and the law give the following. The following are considered as priority sectors. Number one, manufacturing. If you are investing in manufacturing, that one is a priority sector. Number two, even energy, production of energy, that one is also a priority sector. Three, ICT, that is assembling and processing. If you are investing in ICT, mainly assembling and processing, that one is also a priority sector. Education, if you're investing in education, that is also a priority sector. Health is also a priority sector. Agribusiness, is a priority sector. Transport, at least 9 passengers. If you are investing in the transport, at least it should be having 90 passengers and above. That's the one that is allowed. Below 90 passengers, it may not be considered. Tourism, the condition is that must invest at least 1.8 USD, must invest at least 1.8 million US dollar. In that case, that one is going to be considered. Even construction also must invest at least 1.8 million USD. That one can also be considered if it is in construction. Others, I can make any sector approved by the minister concerned where the amount invested is at least 100,000 USD. So any sector which can be approved by the minister concerned, I think Minister of Trade or Minister of Finance, and the amount invested is at least 100,000 USD, that can also be considered as a priority sector. Another important condition, I don't know, I've numbered badly, I think. Another important condition is that if the investor is allowed an accelerated depreciation, must keep the asset for at least a period of 3 years. If an investor is given an accelerated depreciation, or if an investor has been allowed to accelerate the depreciation, in that case, the investor must keep the asset for at least a period of 3 years, meaning that the investor is not allowed to sell the asset before 3 years. If you sell the asset, in that case, the investor will have to pay back the tax lost on that asset and the interest. So if the investor sells the asset before 3 years, the investor will refund back the amount lost, the tax lost, not the amount. I think you can be very clear. The tax lost together with the interest. That is the important condition, that if an investor has not maintained the asset for a period, because you are supposed to keep the asset for a period of 3 years, but if the investor has not been able to maintain the asset for a period of 3 years, in that case, the investor will have to pay back or to refund back the tax lost and the interest. So the interest is calculated from the time the allowance was given. Let's see. I don't know where these are coming from now. Let's look at a simple example that to illustrate this. A simple example to illustrate this. Assume the investor purchased a motor vehicle. Assume that the investor purchased a motor vehicle and is registered. We are putting in that case a motor vehicle of 100 million. Let's assume that 100 million francs. Maybe on 1st January 2020, 2020. Now, then on maybe 10th October 2022, the investor sold the asset or sold the motor vehicle to the more specific. Now, when we are computing our capital allowances, we shall have our motor vehicle, which is going to have a cost of 100 million. Then I recognize my accelerated depreciation. Accelerated depreciation. That is at 50%. So it means this is going to be this amount times 50%. That's going to be my accelerated depreciation. Now, if the investor sells this asset before 3 years, we are saying that the investor must refund back the tax that was lost. So, because the asset was sold in 2022, remember it was purchased in 2020, and then it was sold on 10th October 2022. So it had not yet finished the 3 years. I think it was only 2020, because 2020 up to 31st December, that's 1 year. The second year, so it had not yet finished the 3 years. So it had only finished, I think, 2 years plus and a half, or 2 years and 10 months. So it means in this case, the investor has to refund back the tax lost. So if tax lost will be 50%, 50 million. We are calculating it on the allowance times 30%. So we are getting this times 30%. That's going to be the refund that is going to pay. Is going to pay back that money on that asset. Now we also need to calculate the interest that is going to pay. Now the challenge is, when is this allowance is given? Is it given on 1st of January, or is it going to be given at the end of the year? I think that's the challenge that you may look at this point. Is the allowance given at this point when you purchase the asset, or the allowance is given when you are computing the tax? What I was thinking in that case, that's what I've just got to think about that. What I'm thinking about at this point is that the allowance is given when you are computing the tax. That's when the allowance is given, not when you purchase the asset. It is given when you are computing the tax. So it means the allowance was given on 31st March 2021. So the allowance was given on 31st March when you are computing the tax, 31st March 2021. That is when the allowance was given. So now we calculate from April to 31st March 2022, that is 1 year. Then from April to October, that will be April, May, June, July, August, September. Those are 8 months, I think. 8 months plus 12, that's going to be 20 months. So the interest will be calculated for 20 months. So therefore, the interest is calculated from 1st April 2021 to 10th October 2022, which is 20 months. I think I've calculated well. You can also verify whether it is 20 months or 19 months. So in this case, our interest on the tax loss will be equal to 1.15 million times 1.5% times the 20 months. So I'm getting this times 1.5% times 20. So that is going to be the interest to be paid on this money. So it means you will pay this, the tax lost plus this interest. So a total of 19 million, 0.5 will be paid on that aspect. So that is how you are going to, in case the asset is sold before 3 years ends. So another thing that I want us to talk about on this before we look at an example is to make a simple note that the accelerated depreciation reduces the cost and the useful life if the asset has been accelerated. The accelerated depreciation reduces the cost and the useful life of that particular asset. Now, if we look at this example, we had our cost motor vehicle, which is 100 million. We have accelerated 50%, we got 50 million. It means they recognize the cost for the motor vehicle for tax purpose. They recognize the cost of motor vehicle for tax purpose will be 100 million minus 50 million. So it means your depreciable base will be 50 million. That is the base on which you are going to calculate depreciation. The moment you accelerate the depreciation, the accelerated depreciation reduces the cost of that particular asset. So let's look at a simple example. A simple example on this part, and then we can go on to other parts. This is an example in the notes. You can look at it. We have Boringo received an investment certificate of 400 million as a manufacturing company on that date, meaning is a registered investor. The company did not start its operation until first when the installation of the machineries was finished. The company is located in Nyamagabe district and manufactures hardware materials. The investment in asset were as below. So we have this investment in 2016. We have this. Then 2017 we have other assets. So when we are computing our investment allowance, I'm going to reduce a bit here. So our first asset is land. Then we have building. We have machinery. That's the plant and the machinery. Then furniture, motor vehicle. I'm going to put them under other. Have computer and accessories. Comp and accessories. Then furniture and other. I'm going to put other assets. Other assets. Then I will have my total here. Now in 2016, because it is the first year, I'm going to recognize 2016. I'm going to recognize the costs, the cost of the asset, because that's what I'm having. I'm going to reduce 3 zeros. Land, it is 100,000. Building, the office block and the other of it is the same building. It is 180. We don't separate office block from the building in Rwandan tax law. Plant and machinery, that is 250. Computer and accessories, that is 11,500. Then other asset, I can put it somewhere here. Other assets, I can put them here. Other assets, I have a motor vehicle. Motor vehicle. And the motor vehicle is how much? The motor vehicle is 85 million. But they have told us there is it includes 2 4-seater cars that were purchased for the managers. And we said a motor vehicle to be allowed, it should be having a cost of it should be 9 passengers. So we have the 2 4-seater cars, 2 4-seater cars at 15 million each, which is I think 30 here. So this is going to be how much if I took for capital allowances. Yes, maybe these are the other values we need to look at. Then I have furnitures. I don't know if this figure will help you to understand this. They have summarized them here. Furniture is 2,800. 2,800. Or I would have separated these two for understanding. So the total other assets total other assets will be this plus this, 105, 800, 105, 800. Now, since it is a registered investor, I'm going to compute my accelerated depreciation at 50%. Land does not depreciate, so I'm not going to depreciate land. This is going to be 0. Building, I will get this times 50%. Then I have 90. The same to machinery. Computer and accessories does not qualify because it is below 50,000 US dollar. So it does not qualify for accelerated depreciation. So I'm not going to compute accelerated depreciation for computer and accessories. When I come to other assets, I need to check my categories here. These saloon cars, the 3 saloon cars, the 2 saloon cars, they are not qualifying because they are 4-seaters. What is qualifying is this 55. Furnitures don't qualify because it is below 50,000 US dollar. So what is only qualifying in other asset is these cars which are 55. I'm hoping with exchange rate. So I will get 55 times 50%. So the accelerated depreciation I will report at the end of the year in my profit and loss is going to be this one. This is the amount you are going to recognize in your profit and loss when you are computing tax as a capital allowance for accelerated depreciation. Then that's where we are having a challenge, which I think I've said I will have to highlight in our next class. This challenge on accelerated depreciation, because some are saying if you accelerate, don't depreciate. Others are saying if you accelerate, also depreciate. So there is a contradiction which is going to be solved, I think, by Monday. But in this case, we are going to accelerate and depreciate as we are expecting. So what is going to be the depreciation base? Remember we said that accelerated depreciation reduces the cost of the asset. I think that's what we said. Accelerated depreciation reduces the cost of the asset. So if you have accelerated, then it has to reduce the cost of the asset. So here it means I will get this minus this. That is going to be the depreciable base. So what is our depreciation rate? The dep rate, this one does not depreciate. That is 0%. This one is 5%. This one, it is 50%. And this one is 25%. So I can now compute my depreciation for wear and tear. This one, of course, it does not. So I will have this total here. So it means in 2016, I'm going to have a total capital allowance, our total capital allowance which is this. That is the amount I'm going to take. I'm going to take it to my profit and loss as capital allowance when I'm computing corporate tax. I will have the accelerated depreciation of 242, then I get the normal depreciation of 36. Now, when I come to 2017, now I recognize the cost or I recognize the written down value. For assets which depreciate on cost, I recognize the cost. Those assets which depreciate on cost, I recognize the cost. For the asset which depreciate on reducing balance, then I recognize the written down value, which is the cost minus the depreciation. Even here, I'll have the cost minus the depreciation. Then I can check the new asset purchased. New asset purchased or new asset. Let me just stop here. The new asset in 2017, we have in 2017 we have extension of building 15. That is here 15. Then I have the new asset. I have furniture. Let me take this extension of building, that furniture, then a computer and accessories 3.5. I have here 3.5. Then I have furniture, that is the new asset. We have furniture of how much? Furniture of 2.5. 2.5, 2017. It was 2016. And I have 4-seater car for directors of 10 million each. So it means the total here becomes 40 million for the 4-seater cars. Then I will get a total of 42,500. Still, I don't, other asset, I will have 42,500. So if you look at this asset, no asset that qualifies for accelerated. Building does not qualify because it is below 50,000. Computer and accessories do not qualify, it is below 50,000. Other assets do not qualify below 50,000, even you have the 4-seater cars. So in this year, it means I'm not going to accelerate any asset. I'll only depreciate the assets. So I'm going to get my depreciation base. This is my deep base. So then I can now use the same rates that I have to get the depreciation, which is this rate here times our base. So this is what I recognize in my profit and loss as the capital allowance for 2017. So that is how we compute capital allowances. As I said, we are expecting to get a clarification on this part. So if the clarification changes, of course, I will update you to the changes on how to compute the capital allowances. But for the time being, let's take it at this point on this computation. But I will make a clarification if there is a change because we are still consulting on this part of accelerated depreciation. The question is, when you accelerate, do you depreciate again in the same year, or you only depreciate, accelerate, and don't depreciate? So that is where we are waiting to get clarification. When we get the clarification, of course, I will update you on how to do it. So that is our capital allowances. Please, this part is very important in the computation of business profit. It's very rare to find a question which does not going to require you to compute capital allowances. Very rare. So you will use this part or this information to be able to compute the capital allowances. At least 6 marks or 7 marks will be on how to compute the capital allowances. I don't know if you have a question on this part. Any question, friends, or it is clear? Please make a comment. Okay. So I think we can now continue with our next part of discussion, which is taxation of business profit, of partnership businesses. Taxation of partnership businesses. So I want to emphasize this, that whatever business you are going to tax, whether it is a partnership or it is a company, it is a solo trader, it is a bank, it's an insurance, it's a cooperative, the logic of calculating tax is the same. What you need is what is allowed and what is not allowed. That is the simple logic in the computation of tax. What is allowed, what is not allowed. So I can say that the taxation of partnership businesses is similar to the taxation of companies. That is, partnerships are taxed as a firm, not an individual. I think in most laws, they tax individuals and they are taxed at 30%. So when you are taxing partnership, you tax it as a firm. You don't tax the individuals, which is a bit different from other laws. Other laws, they tax individuals, but in the Rwandan tax law, it is the firm that is taxed, and you are going to tax it as a firm at 30%. The same way we tax companies is the same way we tax partnership businesses. The same way you're going to tax cooperatives, the same way other associations, you tax them the same way. Yes, you add it to the cost because it is capitalized. So you add it to the question, to the asset. if there's an extension of building, that one is capitalized. So you add it to the asset. However, during the taxation of partnership, the interest on capital partners is non-allowable expense, and the dividend income received from local investment is non-allowable. So we are saying when you are taxing partnership, you do the same computation like in any other business profit. However, when you are taxing partnerships, what you need to note is that the interest on capital of partners, that one is a non-allowable expense. It's not considered in the computation. And the dividend income, which is received from a local investment, that one is also a non-allowable expense. It's not allowed for tax. I mean, a non-allowable income. So how do we compute computation of adjusted taxable profits? How do we adjust our taxable profit? When we are adjusting, we begin with the profit before tax. Profit before tax. That's the starting point, the profit before tax, depending on the question you are answering. Then on the profit before tax, we add non-allowable, add back non-allowable expenses. Those expenses which were deducted, but the expenses are not allowed for tax, you add them back. Then we less allowable expenses not considered. They are expenses which are allowed for tax, but during computation, of tax, those expenses were not considered. So you less them. Then we also less non-allowable incomes. They are incomes which may have been included in your computation, but those incomes are not allowed for tax. So you are going to less them. Then we add allowable incomes not considered. Allowable incomes not considered. The incomes, they are allowed for tax, but during the computation, those incomes were not considered. Then you are going to have your adjusted business profit. Adjusted business profit. Now, once you have the adjusted business profit, you can now consider you less your capital allowances. Less capital allowance, which you have seen how to compute. You can also less any loss brought forward. If there is a loss, less loss brought forward. If there is any loss which was, then you're going to have the taxable business profit. Then you can charge tax, your income tax. Remember, it's going to be, because this pro forma, you should use it to any business you are going to find, any business, whether it is a solo trader, whether it is a company, whether it is a partnership, it's any business, you're going to use this pro forma. So if you are dealing with a solo trade business, you're going to compute the PIT. If you're dealing with the partnership, you're going to compute the corporate income tax. If you are taxing company, corporate income tax. Then you charge your income tax. Then on the income tax, we less tax paid. Less tax already paid. You may have a withholding tax, and you can have installments. You can have any quarterly installments. A quarterly installments, then you are going to get tax payable. Please, if you master this, it's going to help you to compute any profit. This is the pro forma for you to use when you are computing. The first, you are going to start with the profit before tax. Then analyze the information you have been given. Look for those expenses which were deducted, but those expenses are not allowed for tax. Then look for those expenses which were not deducted, but those expenses are allowed for tax. Then check the incomes and find out the incomes which were deducted, which were added, but those incomes are not allowed for tax. Look for the incomes which were not added, but the incomes are allowed for tax. Then you're going to get your adjusted business profit. Once you get the adjusted business profit, then you're going to less the capital allowances, which you have already seen in our previous part. Then, if there is a loss brought forward, you also look at that loss which is brought forward from the previous tax. Then you're going to have the taxable business profit. Then you can charge your income tax. After charging the income tax, depending on the type of the business you are taxing, whether it is partnership, it is company, it is individual, it's the same rule of taxation. Then you can less the tax which has already been paid. You maybe have made a withholding on import, a withholding on public tenders, a withholding on interests, a withholding on dividends. Those withholding that were paid, then you less them. If you have made some quarterly payments or quarterly installments, you also less the quarterly installments that were paid. In that case, you get the tax to be paid. That is the pro forma that is going to help you to compute the tax of any business. So I want us to look at this question. It is in, I got it in, I got it in December 2021, question 3B. I want us to look at this, and then from there we can move on to other parts that we need to discuss today. So let's look at this part. Manzi, Rukundo, and Wamaoro are certified public accountants. In 2018, they received a practicing practice certificate and registered their business as partnership, and they operate as MRIU associates, sharing profit and losses in that ratio. On the 31st December, they submitted the following statement of profit and loss for tax purpose. So this is their revenues. Selling and distribution, it has a note 2, office admin expense, finance expense, profit before tax they reported. Then we are coming here. The revenues include the following: audit fees, which is this; other engagement fees, which is this; dividends, it has a note; interest has a note. It said the dividends were received from a local company located in Kigali Special Economic Zone. We have already said that a dividend from a local company is not allowed. The interest was received net from a government bond with a maturity of 2 years. We shall adjust that one. Then selling and distribution, we have advertisement, which is allowed. Donation, we need to consider the 1%. Bad debt, we need to consider. Transport to visit client, which is allowed. The donation was made to one of the client as an assistance to his son's wedding in order to maintain a good relation with the client. Automatically, this one is not allowed. The bad debt is to 2 clients that have closed their business for 2 years now. That is not allowed. So then you can go to office and administration expense. We have salaries and wages. It has a note. So 40% of the salaries are shared by the partner in accordance with their profit sharing ratio. The salaries for partners is allowed. The communication expense related to airtime to the partners, we shall adjust this. The fuel is used by partner when they visit the client. That is allowed. Other effects related to fine paid to Equipara for not adhering to professional ethical principles. The finance cost related to interest on capital charged by partners. Automatically, that one is not allowed. So how do we adjust this? When we are adjusting, so computation of adjusted taxable profit. Of MRIU associates. So as we said, we begin with our profit before tax. Profit before tax, which is, I think we are reporting a reporting in francs. Even I can leave. So our PBT is 96,800. That's the profit before tax. Then we are going to add back non-allowable expenses. So what I need is to check all my expenses and identify those expenses that are not allowed. So I can begin with the first one is selling and distribution, not number two. Others I will come back to them. Selling and distribution, I have advertisement, which is allowed. I have a donation of 10,700. Donation, they said it was made to a client. Automatically, that one is not allowed because it's not to a charitable organization. Donation, I don't need even to calculate 1%. The donation is 10,700. Automatically not allowed. 10,700. Then I go to note number other. Bad debt, it says the bad debt relates to two clients that have closed their business for 2 years now. So that one is still a provision, not allowed, 24,500. Bad debt, 24,500, it's still a provision. It's not yet, no, the other conditions that we looked at are not met. Then I think I'm finished with this one. Then I can go to selling and distribution. Selling and distribution, sorry. Salaries and wages, it has 40% of the shares are shared, but that one is allowed. Communication, they said it is very difficult to separate. So communication is 10,500, 20% is not allowed. Communication, because it is difficult to separate 20% times 10,500. Please ensure that you mute if you are not asking a question. Donatha, and Clement, mute your microphones. Then when I go to transport to visit client, that one is a business activity. That one is allowed. When I come to fuel, it says, I think that's the fuel number. That's what you are asking, fuel. It says the fuel is used by the partners when they visit the client. That one is allowed. Office expense, it says, relates to equipara. This is a fine which is not allowed. 5,700, it's a fine. Not allowed. Five 700 not allowed. I think we are through with this part. The finance cost relates to interest charged by the partners. We said interest on capital is not allowed. So finance cost, it is interest on capital, which is not allowed, which is 110. Huh? Not allowed. So then I raise non-allowable. That's non-allowable income. We have a dividend from a local company. Dividend from a local company, which is they told us here the dividend was received from local company. Our dividend is 48,900. 48,900 was from a local company. Then note number 2 again here on income, its interest. It was received net from a government bond with a maturity period of 2 years. So we are going to less it net and then add it back after grossing it. Less non-trading income, and we have interest on government bond. Interest on government bond, which is 31,300. Then after raising it, I'm going to add it back. Add allowable non-trading income. I still have interest, but when I'm adding back, I should gross. So it is 31,300 times. Remember, this is 2 years. If it is 2 years, it means the withholding tax is 15%. Because it is 2 years. So the withholding tax is 15%. So I will get 100 divided by 85. That one, 300 times 100 over 85. So then I get, this is going to be my adjusted business profit. Adjusted business profit. The good thing, I don't have, in the question, there is no capital allowances, there is no loss. So in that case, it's going to be the taxable business profit, adjusted taxable business profit, because I don't have those other items. So since I said we are taxing at 30%, our income tax at 30% is going to be this times 30%. I get the income tax. Then I less what has already been paid, less tax paid. I have a withholding tax on interest, withholding tax on interest, which is 15% times 36,824 times this. So this is going to give me now the tax payable. That is going to be the tax payable. I don't know if you have a question on how to adjust. When you look at this, my emphasis is to know what is allowed and what is not allowed. That's my emphasis. Because if you look at what we are doing, we are only looking at that issues, what is allowed and what is not allowed. I think what the question was stopping there, we are not distributing. Okay. Any question? Any question, members? I want to hear from you. So can we move on? Okay, you want us to distribute? Okay, I can distribute if you want. Okay, if you want us to distribute the income to the partners, we can do that. Okay, distribution of income, but it was not asked distribution of income to partners. So I have partner, it is Manzi, Rukundo, and Wamahoro. Manzi, Rukundo, and Wamahoro. So their first distribution is the salary. The salary they get. So the salary to remember their total salary is how much? The other point here on administration, he said 40% is the salary of the partners. So the total salary is 85,400. 40% is the salary of the partners. If I put my total here, uh, 40% times 85,400. So these are the now the sharing ratio is 3 to 2 1. I think it's like that. That's the sharing ratio. It means Manzi is getting 3 over 6. 3 over 6 times the total amount. This one is getting 2 over 6 times the total amount. And this one is getting 1 over 6 times the total amount. So that is the distribution of their salaries. Another distribution is the interest on capital. Interest, if I can first get their dividend. Dividend from local company. Dividend from local company. The total dividend from local company is, take note number 1, it is 48,900. 48,900. I'm using the same ratio. Another one is interest on capital. Interest on capital, which is our finance cost. They said the finance cost is 110, 500. 110, 500. So we are distributing it the same way. 1 over 2 over 3 over 6, 2 over 6, and then 1 over 6. The last share is the profit. the profit they are distributing to each other. Their total profit is how much? The total after getting the tax, it's going to be, if I put this, I think it is here, minus the tax paid, which is this. So the total profit is 110, but this 110 includes this one. So it means I'm getting this one minus what they have already said. That's the profit they are going to share. So I'll have this. Then I can have the total shares. So that is how I'm going to distribute the income among the partners. I don't know if you have a question. Any question on how the profit has been shared, how the income has been shared? And we move on. Please be very fast when you're making. So we can go to the next part, which is going to be now corporate income tax, which is a sure deal question. Corporate income tax. I think we abbreviate as a
Auditor's Code of Ethics or Professional Accountant Code of Ethics.
corporate income tax. So let's look at this very, very critical area in your exam, the corporate income tax. And I'm going to mute you all because I'm hearing others attending 2 classes at a go. I really don't know how we even do it. When you have a question, you can put it in the chat or you can raise the hand. Let's discuss one of these key area in the taxation of business profit. That is the corporate income tax. Corporate income tax, it is a tax that is paid by companies and other associations, as we have already talked about the previous one, which is partnerships. So associations like companies, partnerships, cooperatives, they all pay banks, insurance companies, they all pay corporate income tax. And I want to emphasize this, that the computation we have seen in our previous part is similar to the computation that we are going to look at in other parts. Similar. What is important is to understand what is allowed and what is not allowed. That's the most important aspect in the computation of tax. So we can say that CIT, that's the corporate income tax, it is the tax paid by companies and other associations like partnerships, cooperatives, government parastatals, government parastatals, etc. They all pay corporate income tax. And the CIT rate is 30%. And the tax period is from 1st January to 31st December. That is the CIT rate is 30%, and the tax period is from 1st January to 31st December. So, however, there is exception. If companies have listed shares in the RSE, Rwanda Stock Exchange market, they will be taxed as below. In the next 5 years. Although the normal CIT rate is 30%, but if a company has listed shares on Rwanda Stock Exchange market, it receives a tax discount. So it will be 20% if it has listed 40% shares to the general public. That is number one. Number two, 25% if it has listed 30% shares to the general public through all of them, they should be through Rwanda Stock Exchange market. And 3, it will be 28% if it has listed 20% shares So the normal tax rate is 30%. However, if a company has listed shares in the London Stock Exchange market and those shares have been sold to the general public, the company will receive a tax discount in the next 5 years. Please, these discounts are not forever. They are only for a period of 5 years. If it is listed in 2022, you expect it goes up to 2026 or 2027, and then it stops, then it go back to 30%. So if it has listed 20%, if it has listed 40%, the CIT will be 20%. If it has listed 30%, the CIT is going to be 25%. If it has listed 28, the CIT will be, so if it has listed 20%, the CIT is going to be 28%. And I'm saying the tax discount on listing of shares is only for a period of 5 years from the date of listing. So you count 5 years. After 5 years, the company goes back to 30%. Let's discuss this corporate restructuring. Corporate restructuring. Corporate restructuring, it is defined as either the merger it can be defined as either the merger between two resident companies, where two resident companies combine and form a new company. That can be a corporate restructuring. Number two, an acquisition of 50% capital by a resident company through issuing of shares. A resident company acquire another resident company, but it has acquired 50% or more than 50%. The minimum should be 50% of another resident company, but the acquisition is through issuing shares. If the acquisition is through issuing shares, then that one is going to be classified as a corporate restructuring. Number three, an acquisition No, that one is not there, Vianney. Let me check the new. I think there is something that I have. Let me check the new code. I think I saw something like that. But I think I'm going to check the new codes in the break time, and then I will come back to you. The new investment code, as if I read something like but I'm going to check. That one is in the new code. I'm going to check the new investment code, and then I'm going to come back to you on that part of employees. The new investment codes. An acquisition of 50% assets and liabilities of another resident company. So it acquires more than 50% of assets and liabilities of another resident company. That one is also a corporate restructuring. Then another one, a takeover of a resident company by another resident company. If there is a takeover of a resident company by another resident company, then that one is also going to be considered in a corporate restructuring. Then you have the last one, splitting a resident company into two or more resident company. If you do a capital restructuring and you split a resident company into two or more companies, that one is also considered as a corporate restructuring. Now, of course, an exam question can never tell you that this is a corporate restructuring. But look at the definition of look at how the question is and find out if it is about corporate restructuring. So what is the tax implication? Tax implication of corporate restructuring. Tax implication of corporate restructuring. Now, the main tax implication, if you identify that the question is about corporate restructuring, the main tax implication is that the transferring company is exempted from the capital gain tax and loss. As long as it is a corporate restructuring, the company that is transferring is going to be exempted from the capital gain tax and the capital gain loss. It's not going to pay tax on the capital gain tax, and the loss is going to be considered as an expense. That's what it means. In a case it is a corporate restructuring. Number two, the acquirer should recognize the assets at their book value. To depreciate. The acquiring company should recognize the asset at their book value. As long as it is a corporate restructuring, the company that is acquiring the asset should be recognized at their book value. And the company should continue to depreciate the asset as per the previous policy of the company that has been acquired. So you don't change the depreciation policy when there is a corporate restructuring. So these are the key tax implications when it comes to corporate restructuring. Please, always look at the question well and find out whether the question is about corporate restructuring or not. If there is an acquisition, a resident company has acquired another resident company but has acquired 40%, that one is not restructuring. But if a resident company has acquired another resident company and has acquired more than 50%, automatically that is a corporate restructuring. And then if you look at that, the implication that you're not going to compute capital gain tax. And if it is a loss, the loss should be considered as an expense. So that is the corporate restructuring. Another thing before we look, maybe yes, Chris. Jambo, niko darasani, nitakupigia baadaye. So in that case, that's you have to work on to look at that. Please always analyze the question well and find out if the information given in the question meets this definition. If it doesn't meet the definition, then you compute the capital gain in case there is a transfer or a sale. But if it meets the definition that we have talked about here, in that case, it's going to be a corporate restructuring. Let's also talk about this resident company. We looked at resident in the video. A resident company, it is a company that has been, one, it was established under the London commercial law. Two, it has a central management or administration in Rwanda. It has got a permanent establishment in Rwanda. It is a Rwandan government company. That one automatically is going to be a resident company. It is established according to the Rwandan commercial law. has a permanent establishment in Rwanda, has a central management, now a resident company, it must meet either of these conditions. It is established according to the Rwandan commercial law or Rwandan law. That one is a resident. The company has got a permanent establishment in Rwanda. Automatically, that one is going to be a resident company. It has a central management or administration in Rwanda. That one is a resident company. And two, a government of Rwanda company. A government of Rwanda company, where it is a resident in Rwanda. Now, what's the tax implication? It's almost the same that we looked at. A resident company is taxed on the income generated both in Rwanda and outside. If it is a resident company, it will be taxed on the income it generates in Rwanda and the income it generates outside Rwanda. However, there is a resident which is a foreign company. It's a resident but a foreign company. A non-resident company is only taxed on the income generated in Rwanda. If it is a non-resident, it will only be taxed on the income it has generated in Rwanda. You don't tax it on its other income. You only look at the income generated in Rwanda. So that is the tax implication for this. So another thing I want us to look at before we go for break is liquidation. If a company has been liquidated, so if a company has been liquidated, the liquidation proceeds in case a company has been liquidated, meaning you have ended the activities of the company. The company was operating in Rwanda, but now you are ending its activities in Rwanda. The proceeds from liquidation is taxed at 15%. You tax it the same way you are taxing dividends. How do we compute the proceeds from liquidation? Computation of proceeds from liquidation. We shall get the proceeds from the sale of assets, proceeds from the sale of assets. We less the liabilities. We less the share capital. Then you are going to get the proceeds from liquidation. And we are saying once you get these proceeds, the tax is at 15%. You tax it the same way dividends are taxed. Let's look at a simple example here, probably a simple example on this part. And you can say that company X has been operating in Rwanda for many years. In 2021, the company terminated its its activities in Rwanda. The proceeds from the sale of assets are 500 million. The current outstanding liabilities is 300 million, and the share capital is 100 million. Sorry. This is a simple question that I want us to look at. Company X has been operating in Rwanda for many years. In 2021, the company terminated its activities in Rwanda. The proceeds from the sale of assets were 500. The country outstanding liability, they are 300. The fully paid capital is 100. Then we compute the tax on liquidation. So this is a simple case scenario. We said we're going to look at the proceeds from sale of assets, proceeds from disposal of assets, which they have told us it is a 500. Then we less liabilities outstanding. liabilities outstanding, which is 300. We also less the share capital, which is 100. So the liquidation proceeds will be 100 million. Then tax on liquidation at 15% is this times 15%. Then I'm getting the tax on liquidation. So that is how we are going to compute the tax on liquidation. So that is the liquidation. Another thing before we go for a break, we can talk about is a loss. Not necessarily loss, it's a loss for business or tax loss. This would have been in any part, because it either any business you can get a loss. That's what I'm saying. If a business gets a loss from operation, the loss can be carried forward for a period of 5 years, and the area loss is considered before the latter. The loss is so in case any business, it can be an individual, it can be a solo trader, it can be a company, it can be a partnership, any business, it is allowed to carry forward the loss. So if a business gets a loss on its operation, it is allowed to carry forward the loss for a period of 5 years. It can be extended to 7 years, depending on the circumstances. If you give good reasons, it can be extended. So, but you can carry forward the loss for a period of 5 years. And when you are considering the loss, the first loss or the earlier loss is considered before the latter loss. And please, a loss is adjusted from or is reduced from the adjusted profit before computing the tax. Before you compute the tax, then you should adjust the loss first. I think you saw our pro forma. Before we compute the tax, then we consider the loss. So if you have a loss, probably year 1, year 2, these are year 3, and maybe you have profit here or loss. Year 1, we made a loss of 10M. Year 2, we made a loss of 5M. Here, we made a profit of 8M, and year 4, we made a profit of 3M. Let's say this. So when we are looking at the loss relief, we are going for the loss relief. This loss will be carried forward here. So here it is still there. It goes. Then here you are going to reduce it of 10M. If you reduce 10M here, you are remaining with 2M. 2M. The 2M is the one that you are supposed to carry forward. Remember, you have also this loss of year 2 of 5M. So when you come here, we first consider this loss before considering the loss of year 2. So we shall have to first less the loss of 2M. You remain with the profit of 1M. Then in that case, you can consider the loss of 5M. And then you can carry forward the other loss of 4M in this case. That's what we are saying when we are considering the loss. The earlier loss is considered before the latter loss. But what is important that if you have a loss, the loss should be adjusted from the profit before computing the tax. So that is a loss, a business loss. What I think now, what is now remaining is to look at a example probably now on this part. I think we have looked at the key area that we need to talk about in this part. What is remaining is now to look at the example on CIT. So we are going to have a break of 15 minutes. After 15 minutes, we are going to look at an example on CIT. And then we can move on. Probably tomorrow, I think I will contact Sepe and we can meet from 1 to, or from 2 to at least we can meet for 2 hours or 3 hours. I will contact Sepe and we discuss that. You can meet during the day after your day class. We can meet from either 1 or from 2, depending on when you finish your class there. Because in evening I have another class. We cannot meet in evening, but we can meet in day, during the day, after your academic classes. So let's get a small break of 15 minutes. Then we can look at the question. Then after that, we can move on to other parts that are necessary still in corporate income tax. So 15 minutes break, then we are coming back. I hope you are back and we can move up with this question. Uh, let's go through the question and then we can see what is required. Uh, okay. That is a, I think what you are looking at is a partial disposal. I think it's Vianney has a question about how to calculate a gain on disposal of land. Example, the company had purchased 20 hectares of land at 50 million. During the year 2016, it disposed 5 hectares of land that had no use at, at the 12 million. This is what we call a partial disposal. Probably I will talk about it at a later stage. That is partial disposal. We shall talk about it briefly. That is partial. We call it a partial disposal. You need to get the cost of the part of the land that has been disposed, and then you determine the value, which is A over A plus B, where A is the value of the remaining the part disposed, and then you get it. We are going to. I think remind me. We shall look at it on as part of our emergency issues. But briefly, if I'm to do it here, I will get the. So the cost of the land is, you said it is 50 million. That's the cost of the land. Value of the part disposed is a value of part disposed is 12 million. Value of remaining part is it 48 million? I think from your message. The value of the remaining, where is the message? The value of the remaining part is 48. The incidental cost on sale is 800. Incidental cost on sale. Incidental cost on sale is 800. Then we're supposed to compute the capital gain. We're supposed to compute the capital gain. So what you need here is the cost of the part disposed. Cost of the part disposed. And we use the formula of or total cost times A over A plus B, where A is the value of the part disposed, is the value A is the value of the part disposed, and the B is the value of the remaining part. The value of the remaining part. So in this case, the cost of the part disposed will be equal to total cost, which is 50 or 50 times 12 million divided by 12 million plus 48 million. So I will get, if I'm to do it, it will be 50M 50 times 12 divided by 60, and that's going to give us 10 million. That's the part of the area disposed. So this would be the cost of the area, 10M. So which is equal to equal to 10M. So if I'm to compute the gain, the capital gain here will be proceeds from disposal, proceeds from disposal, which is 12 million, less incidental cost on sale, incidental cost on sale, which is 800, this is the net proceeds. Then less allowable cost, we are going to have the purchase, the cost of the asset, cost of the land, which is 10 million. Then I can compute my capital gain. Then the capital gain tax at 30%. Then I compute that one. I think I've answered your question on how to compute this. What is important here is to know how to compute the cost of the part disposed, and then you can be able to compute the other parts. This was a by the way question someone has asked. It's not part of this question that we are trying to attempt. So this is a question from April 2021. Question number 1. Alpha Limited is a multinational enterprise incorporated in Rwanda in 2018 and started its operation in January 2019. Was registered with the Rwanda Development Board and obtained its investment certificate. Alpha Limited deals in the manufacturing of textiles. So it is a registered investor and it is in a priority sector, manufacturing. Its main plant is located in Kigali Economic Zone. Alpha Limited has branches up country and out of the country and has made different investments on African continent. The management submitted this for assessment. So this is what was submitted for tax assessment. And the closing stock was valued at a cost plus a markup. So it was overstated. Dividends were received from an investment made in Mauritius, net of tax. Rwanda has a DTA with Mauritius to tax dividend at 10%. Profit received was from South Africa, a branch of that. Included in salaries and wages are body sitting allowance of that, and the penalties to delay of that, pay of that. So the sitting allowance are allowed, the penalties are not allowed. Staff meals include the following: staff party, not allowed. Staff water and tea at offices. If it is given to everyone, that one is allowed. It was discovered that a prepayment of house rent for the CEO amounting to this per month for 2 years ending this was omitted into the books of accounts. So the company is paying rent, but this was not recognized. It is the company's policy to account for provision for doubtful debt at a rate of 1% of the turnover. This provision was included in the bad debt, so that one is not allowed. Legal expenses include factory insurance policy of this for 2-year expiring, so there is a prepaid. Repair and maintenance included an equivalent of 70 million, which was the purchase of machinery in the public auction. The expense was not capitalized, so you need to recognize that one. Traveling and communication expense related to the car fuel and telephone, who's private, so you know how to deal with that. Management were paid to non-resident persons. These are the depreciations. So you have the cost of the asset at the beginning in 2019. As a tax auditor from the tax administration, compute alpha capital allowance for the year ended 31st December. So these are the assets we have. I think we can separate land. We have building. Plant and machine, P and M. IT systems and software, computer and accessories. I don't know whether these IT systems, they are above 10 years. That's where the challenge is. IT systems, they didn't provide whether they are above 9 years, 10 years. The question did not provide that. I'm going to compute to put them into computer and accessories because the question has not is silent on it. So you can separate them and assume they are 10 years, or since they separated, we can assume them they are maybe 10 years. IT systems. Then we have computer and accessories. And then we have the other assets. So the value here, first we recognize the land, so the cost. The cost, this is 168. The cost, then you have the building is 3.5. Then 365, 7. Then I have, I had skipped, I think, the motor vehicle. I'm going to put them in other asset. Motor vehicle, I'm going to put into other asset. ICT, 275,000. Then computer and accessories. I'm assuming that IT equipment are above, they are above 10. They are 10 years and above. That's why I've separated them. Computer and accessories 56. And the other assets, I'm getting this 124 plus 92, which becomes what? 124 plus 92. To get the other assets, 124,000 plus 92,000. So those are the other assets. I've combined them. Now I can go back to my information to get it very clear what they say. Alpha Limited is a multinational incorporated in 2018 and started its operation in January 2019. That's when it started operating. It was registered with Rwanda Development Board and operated, so it is a registered investor from 2019. So in this case, I'm going to compute my accelerated depreciation. Accelerated depreciation at 50%. So here we don't, but here it's going to be 50% times this. So the good thing, all the assets I'm seeing here, they qualify. So once I compute, then I can get my depreciation base. My dep base, which is going to be this minus this. That's the depreciation base. So depreciation rate, our dep rate, this is 0%, we know it. Building 5%, plant and machinery the same here. IT equipment, I'm assuming they have 10 years. These ones, 50%. And here we have 25%. This will be my total. So here I'm going to add my accelerated depreciation. Is that. Now I go to 20 to depreciation. So of course here it will be 0. What is it? So then I can add to get my total depreciation here. So my total here will be this. So that will be the capital allowance that we are going to take to profit and loss for this year. I can get my balance carried, the written down value at the end if I want, written down value at 31st December. If I want, which will be this minus this. So that is how I'm going to, that's my capital allowance that I'm going to do for this question as it is requested in the question. Now the second part of the question, it requires compute the taxable alpha taxable income, tax paid to be paid, and the tax payable for the year ended this. So we are computing computation of taxable income and tax payable for alpha. So as we said, we are beginning with our profit before tax. That's the beginning part. We are beginning with the profit before tax. I think we are reporting in the thousands. We are reporting in the thousands. So we are beginning with profit. Our profit before tax. I can check. The question was wrong. It is this one, 3207 750. It is a loss. 3207 750. Then I add back non-allowables, non-allowable expense. I can now start checking my expenses for those expenses which are not allowed. So we can begin with the question was very opening stock. We had a closing stock, but they said the closing stock was valued at a cost plus a markup, and we know that the law, when on valuation of closing stock, it is either cost or the realizable value. The lower of cost and the realizable value. So in this case, if it is overstated, then it means our profit was overstated. So we shall need to look at. So it means this one is a closing stock. What is it? It is 2.4. It was overstated. So if it is overstated, it increases this one. So we shall have to less overstated closing stock, which is going to be 5 over 105 times 2.4. I'm in class. Can I call you later? Yeah. So it will be 5 over 0.5 times repair and maintenance included an amount equivalent to 7, which was, but we have not yet reached there. You are taking me fast, I think, Mr. Hey, there is a repair and maintenance. Sorry. Yes, you are true. An additional asset here. I did not look at it. I think I can add it here. Machine. We can add it 70, I think, here. Plus 70. Yeah, I think I've adjusted it. Thank you, Mr. Vianney. So then I can go to the next one. We can first ignore these incomes. We are going to look at them later. Salaries and wages, does it have a note? Dividend, I know these notes were not very okay. Including salaries and wages, board director sitting allowance of that one is allowed. And the penalty for delay to declare, penalty is not allowed of 28. That one is not allowed. We have a penalty of 28. Then another expense is staff meals. And they said we have a staff party. That one is not allowed. That's entertainment. Staff party of 175, not allowed. Then this other staff water and the tea at offices, that one, if it is available to everyone, it is allowed. So you can accept that one if it is available to everyone in the organization. Then another one is management and technical fees. Management and technical fees, it says it has no note, I think. The management and technical fees. Management were paid to a non-resident, so we need to compute the working here. The management and technical fees, we need to provide the working. It is how much? Management and technical fees is 580. I can make a working here. My working number 2. The working number 1 was the capital allowance. Management and the technical fees. Amount paid is 508,450. 508,450. Allowed is 2%, because it was paid to a non-resident. 2% times 10.5 million. 10.5 million. Two percent times 10. So not allowed will be this minus this. 298,450. So management and the technical fees. Working number 2 is 298,450. 298,450. Another expense is research and development. I don't know if it has a note. Research and development. Research and development. It has no note. We are going to accept. We are going to assume that it was used in the business activities. So since it has no note, when we say note, probably we should adjust. Advertising and marketing. I don't know if it has a note. Advertising and marketing. Advertising and marketing. Yes. I don't know what you are saying, Clement. I have applied capital allowance. You have applied reducing balance on all items. I've not calculated the depreciation in the next year. I've just shown the written down value at the end, but I've not calculated anything. If I go to the next year, some asset I will show the cost, others I will show the written down value. That's why I just stopped there. I think then here I'm looking for advertisement. Members, you can also assist me to look for that if you have seen it. I think I don't have information on it, so I'm not going to allow it. I'm going to allow it. Training and capacity building, I don't have information. Repair and maintenance, they said 70 million is capital. Sitting allowance, they are taxed under, they are taxed, they are allowed these days because they are taxed. Repair and maintenance, we have a 70 million, which we said. Repair and the maintenance. The 70 million, which is capital expenditure, is not allowed. Then I can go to salaries and wages. That's when we have finished there. Then I come to loan interest. I don't know if it has a note. Loan interest. Loan interest. Loan interest. Loan interest has no note. So I'm allowing it. I'm assuming it is a business. Legal expense, I think it has a note. Legal expense. I saw it where it is here. Included the factory insurance of this for 2 years. So we have a prepaid insurance. Prepaid insurance. Prepaid insurance of 9,600 divided by 2. 9,600 divided by 2. Huh? What did I say? 9,600 divided by 2. Then I can go to traveling and communication. You said you cannot separate, I think. Traveling and communication, if you read that note, you cannot separate. So 20% is not allowed. Traveling and communication is how much? 4,700. 20 plus 47,200. Traveling and communication is going to be 20% because you cannot separate, times 47, 200. 20% times 47, 200. Then I go to another one is donation. I don't know whether they gave us information on donation. Any information on donation? So here you can assume two things. You can assume that the donation is for charity and you calculate 1%. But you can also assume that the donation is not for charity because the question is silent on it, whether it is charity or not charity. So if I assume that the donation is not for charity, then I'm going to add back the whole amount. But if you assume that the donation was made to charity, then you have to calculate 1% of your sales. So for me, to simplify this, I'm going to assume that the donation is not for charity. Donation, but not for charity, because the information is silent. Donation not for charity, 350, 950. 350, 950. Another transaction is a bad debt. This one has an information, I think. The bad debt, I think I read something about like a bad debt. Yeah, it's the company's policy to account for provision for bad debt, bad and doubtful debts at a rate of 1% of turnover. This provision was included in bad debt. So it means 1% of the turnover should be removed. Our turnover is 10,500. I think I calculated this somewhere wrongly because I used 10,400 somewhere. Yeah, I think it is true. Is it on what? Okay. Provision for bad debt. Provision for bad debt. It's going to be 1% times 10,500. That one is not allowed. The other bad debt may be allowed. 1% times 10,500. That one is not allowed. Then I go to goodwill. Goodwill is an asset, not allowed, but you do not even amortize it. Goodwill, goodwill is not an expense. 2,500. We are going to add it to our capital allowance goodwill. Then depreciation. This is also accounting. We are not going to allow it. Depreciation. This is 900. You are not allowed. Then I go to VAT declared and paid. That one is not allowed. Yeah, VAT 4 million. It's not an expense. Then we have withholding tax on public tender, not allowed. Withholding tax on public tender. Which is how much? 245. So that one is also not allowed. So I think from what we have seen, these expenses are not allowed. And I think, I don't know if I've left something else here, including sales and wages. We have looked at that stuff. We have looked at this. Then we are going to look at the incomes, I think. So that is it. Then we are going to less. If you look at this expense, what if you assume that the notion is charitable, then you are going to compute 1%. 1% of your turnover and compare what was donated. If you assume that the donation is charitable. I want us to look at this expense on note number what? It was discovered that a payment of house rent for CEO amounting to 500 per month for 2 years, ending at 31st, was omitted in the books of account. Is this a business expense? Rent of house for COO? I think this is already an employment income, so we don't look at this one. This one we are going to ignore it. We're not going to consider it. It's not a business expense that was not recorded. So we are going to ignore this business expense. So I'm going to less the non-allowable incomes. We can now check our incomes. Other incomes, we have gain on sale of motor vehicle. It is allowed. Interest on saving, I don't know if it has a note. Interest on saving, it has no note, but we are going to allow it, assuming that it's allowed. The company is making maybe a fixed deposit, it's investing in a fixed deposit, that is going to be taxable. Then we have dividend received. That is, I think it has a note. It says dividend were received from our investment in Mauritius, and so we are going to look at this. And then another one is a VAT refund. A VAT refund is not an income, so this one is a VAT refund of 100 million. Then we have another income is exchange gain. The exchange gain is taxable. It's allowed. We have a profit received of 658. So it has an information here. Profit received from South Africa, its branch operating this at 28. So we are going to adjust that, I think. So the only non-allowable here is this. Then we are going to consider this income which we already taxed net, less the non-trading incomes. We are going to less them net and add them back when they're gross. We have a dividend. which is 165. Which is 165. Then we have the profit from branch. Profit from branch is 658. So additional information number 6. Number 6. For me, I'm seeing as if this is not a business income. Rent for CEO. The company is paying rent for CEO. And it was not recorded. If it was recorded, we would have added it back as an unallowable expense. But since it was not recorded, we are not going to consider it. For me, I'm not seeing it as a business expense, but we can also exchange ideas. But for me, I'm seeing it as if it's not a business expense, because the company, the rent, the housing allowances are given within the rent. And since it was not recorded, it means you are not taxed. Then add back allowable non-trading. Non-trading incomes. I still have these two, but when I'm adding back, I should add them when they are gross. I should gross them. For example, dividend, it was 10%. So I'm going to get 100 over 90 times 165. It is 100 over 90 times 165. The other one is profit from branch. It was taxed 28, so it will be 100 over 72 times 658. $100 over 72 times 658. So I get how much? So this is the adjusted business profit. The gain on disposal is taxable. That's why we have not considered it. It is taxable. And it was already included. Now, it's non-trading income. Why are you saying that? I don't get you, Eric. But the tax law recognizes the proceeds from the sale of an asset. That's the gain on disposal. So it is a taxable income. So then we can now less our capital allowance. If there's something of information I've forgotten, capital allowance. Remember we had forgotten a goodwill here. I think we can add it somewhere. I don't know. Before the total. I don't know where we can put the goodwill because you have a goodwill also. We have a goodwill of 2.5. They are going to depreciate it at 10%. So we are now going to have a total capital allowance of this. So at the end, we are going to have a tax loss. We have a tax loss. So this loss can be carried forward for the next 5 years. And we can now compute, we less the tax paid already. Less tax paid. We have interest on saving. If it is interest on saving, it's interest on saving. You don't withhold this, maybe if it is below, above 1 year, but it is taxable. It is calculated. So we are assuming that it is above 1 year. There was no withholding tax on it, but it is a business income. So we have withholding tax on dividends, withholding tax on dividend, which is 10%. 10% times 183. 333. Then I have income tax on profit, which is 28 times 913,889 times 28%. Then I have withholding tax on public tender. On public tender, think we got how it was how much it was. We consider it somewhere 245. So tax claimable. These are going to be the tax claimable. So that is how we adjust for taxable profit and how we compute the tax. So I don't know if you have a question on this part. I don't know if you have a question that you want us to talk about on this part. I hope there's no information we have forgotten on this question, because information was very not very straightforward. How you get the tax claimable? I've added the withholding tax on dividend, the income tax paid on foreign profit, and the withholding tax on public tender. Then I got the tax to be claimed. Why do you add instead of deducting? Deducting from what, Aphrodite? Because this one is already tax loss, we cannot adjust anything. This is going to be carried forward. But these taxes have already been paid. So the company will have to claim these taxes. So any question? Any question? We are almost finishing our question. This one I think you can do it. The liquidation. This is what we have just finished studying. Liquidation here. So you can do this one very fast, I think, from that what we have looked at. So members, I think we are stopping here. How to deal with that public tender? If there is a withholding on public tender, that tax is claimable. When you compute the corporate tax, then you should reduce the withholding on public tender. Is it okay, Eric? So I think we are stopping here. If you don't have a question, I'm going to send the Excel to Sepe. Sepe, I will call you probably in evening, and we discuss our next class probably next week. I was planning that after your class during the day, we can be meeting for at least 2 or 3 hours. But I'm going to call you and we discuss that. So I'm going to send the Excel to Sepe, and then he can share with the colleagues. But today I'm seeing the number is too much. I don't know where others came from. Because the class they told me is only 6 students, but I've seen very many students today. I don't know where others came from, but that's not okay. That's okay still, sorry. Okay, have a good day. I think I'm now going for I think another class somewhere. So I will call you and then we discuss. So have a good day.